Well, hey, thanks for joining us again. We're going to spend some time with Casey Hazen, Senior Portfolio Strategist with Horizon. Casey, welcome back. How have you been?
Yeah, I've been great. Thanks for having me again, Chris. Looking forward to this.
Yeah. Yeah, same. It seems like some positive things have been happening in the market. And, the good thing is it seems like with some of the hurdles we've had, we seem to be jumping them fairly well. So I know that today we kind of prepared to talk about a few different outcomes and that there's options, right? We may muddle through this current economy and it may just maybe not necessarily stagnate, but just kind of slow and go. I believe we also have talked and prepared for what if AI just creates a capex, a capital inflow such that things boom, or what if these things fall off and things don't materialize the way we would hope? So I know that we got some things we want to talk on as it relates to labor before we get into that. But Casey, why don't you take the ball?
Yeah, thanks. You're absolutely right. Things have been generally pretty positive. I mean, you look at the stock market and the bond market, both have been moving in a pretty nice positive direction. But that doesn't mean that there hasn't been uncertainty, right? Kind of pointed out that today we're going to talk about a couple of different directions we could go in from where we currently sit today. And we are at, I would say, an inflection point, right? We just had the Fed cut interest rates once again. And this could signal a couple of different things, right? It could signal things could potentially be getting worse. And so the Fed needs to step in and reduce borrowing costs, stimulate the economy because they see some sort of really negative outlook going forward. That does happen. And obviously, that's more of a recessionary signal. That's not positive for the market. But it also could be signaling something like, the Fed just wants to normalize things because things are actually trending in the right direction. And so we just don't need to be as restrictive with higher borrowing costs. About half the time over the last, handful of decades, when the Fed has gone into a rate cutting cycle, about half the time it's been into a positive economy. And that's that really light blue line up there tends to be very, very positive for forward-looking stock market returns. So really what this chart here is showing, we could be going in different directions. We could, be very positive, we could be very negative, or we could continue muddling through. And for us, like what we would need to see for some of these different scenarios to play out, you look at the muddle through scenario. I think that's how most people feel right now. Things are just kind of stagnant, things feel stuck. You look at the labor market. The labor market has definitely been softening. We've talked about this over the last couple of quarters when we've had these
Yep.
reviews. This chart here is looking at hiring rates. Hiring rates have really fallen off a cliff, right? Since 2022, kind of post-COVID, things were really great. It was very easy to get a job. That is no longer the case, right? That's definitely not a positive signal, right, for the labor market if it's hard to get a job. That's
Yeah.
something that's kind of concerning, from an outlook perspective. And we've also seen the labor market from unemployment perspective move in the wrong direction as well, right? This chart here is a much longer looking, overview going back all the way to the early 90s. And so where we currently sit today with unemployment, still very, very low from a historical perspective, but it has been kind of moving up off of the lows that we saw back in 2022. So that's where you
Mhm.
hear a lot of the negative headlines around unemployment moving higher, um, hiring rates extremely low. That's all very, very scary. But we do think that if you kind of take a step back, we're not in a terrible place right now as it sits with the labor market. Yes, unemployment is moving a little bit higher, but it's still relatively low. Layoffs right now are still historically low. So we're in this low hire, low fire labor market. And that very much is kind of like this scenario where things will continue to muddle through. That's not a scenario where you're going to get, a boom in economic growth, but it's also not a scenario where you're going to see, a massive recession because what this chart here specifically shows is that most people have a job, and as long as people have a job, they're going to continue to participate in the economy. Retail sales are still relatively healthy. So if we don't get any, further inflection higher or lower from here, it's going to be more of what we've seen over the last couple of years where, things feel really, really bad, but we're seeing underlying health within the economy. And so it's just kind of this very much muddle through, stuck feeling that everybody has.
Casey, to break from the script for just a second, I can't recall a time where you and I have talked about something that was tentative in the economy or potentially strenuous or dangerous, where there wasn't some bigger context that really made you feel a little bit better than just the headline or the clickbait, as some people call it, would lead you to believe. So here we are talking about labor rates, but in the context of what I'm looking at going back, what, 30, 35 years, we've seen some better economies, regardless of what that may be. So I feel like in context, we can take this in stride, hopefully. Would you agree with that?
Yeah, no, absolutely. Things are not as bad as the media wants you to feel.
Yeah.
But again, like that's not to say that there aren't risks. And so, kind
Sure,
of
of
like
course.
dovetailing off of that, what would we need to see for us to feel like the economy is going in the wrong direction? It
Okay.
all does come back to the consumer, right? And the consumer health is directly tied with the labor market. And so this chart here is looking at consumer spending so far in 2025. Obviously, a lot has happened this year, to impact consumer spending. We've had Liberation Day, we've had inflows of tariffs to the extent that we haven't seen in decades. But consumer spending still relatively healthy, growing at right around 2% year over year. So far, haven't seen too much spending on the consumer side or too much stress on the consumer spending side. But it is definitely something that we're watching. There are concerns around, these tariffs, increasing inflation. And if the labor market does crack, all of a sudden that really puts a lot of stress on the economy. The other thing that we're watching very closely, and obviously right now this has been more positive, but could potentially lead to stress on our economy, is just the massive amounts of spending coming from these tech companies related to AI infrastructure, data centers, really whatever you want to call it. We've all seen and heard, it's been in the headlines how, these tech companies are pledging to spend hundreds of billions of dollars on these new projects. And this chart here looks at our GDP growth rate for the US, and the contribution from just tech capital expenditures. So that's just, the projects that they've announced versus the rest of the economy. And normally CapEx is very, very minimal, especially coming from the tech space. You go back just a couple of years, it was almost non-existent. As of the second quarter 2025, our most recent data, you can see it makes up almost half of our GDP growth that we had for here in the US. And so, yes, that's been positive and that's been offsetting maybe some potential weakness coming from the consumer side.
Yep.
But it is very much a risk. There's concerns that these tech companies are spending way too much money on this AI infrastructure build out. There's no way that it can be as profitable as they expect it to be. And so they're going to have to pull back their spending at some point. That's really the negative scenario that could
Right.
potentially play out. For us, we don't see that happening anytime soon. You hear from a lot of these tech leaders like Mark Zuckerberg, who kind of says, they would much rather overspend than underspend.
Right.
And the gameplay right now, if you're a tech company, is put as much money as you possibly can into this AI arms race that's currently going on. So
That's right.
we do expect that to be a positive tailwind, but down the road, it could potentially turn into a negative tailwind. And since it is making up so much of our GDP growth, that could potentially push us into some sort of, negative growth scenario.
No, that makes sense. That's kind of like how in years past, I think this would equivalate well that when you've had, whether it was the Magnificent Seven high flying stocks or the FANG stocks before them, when they controlled so much of the market share, if they started to fall out of favor, we would feel weakness in the broader markets because they comprise so much. So it seems like in the same way, if I'm tracking with you, that we really may need some of this capital expenditure from the tech companies. And I see what you're saying. It's like a global race. It's either we're going to invest and do whatever it takes, or we may become obsolete. So there may be some places where they're just going to go deeper into debt if need be, and lose the battle anyway, right? Just like
Very much.
Sirius and XM satellite radio, they were either going to merge or someone's going to lose because the technology doesn't need both of them, right? So
Exactly. Yeah.
anyway, okay, I think I'm tracking with you. So that's about the
Yeah.
same there. Okay.
And exactly, while this could be, a risk to our economy, obviously right now it is also being viewed very much as a tailwind. And a way to think about it is more like a stimulus package, similar to what we saw post-COVID, although on the corporate side. And so this chart here just looks at, again, infrastructure, capital expenditures, so these spending plans that these tech companies have announced. What is like, how large is that as a percentage of our GDP compared to some other large infrastructure projects that we've had in our past? Railroads back in the 1880s, obviously that was a massive project, as a percentage of GDP, much higher.
Yeah.
But a more comparable analogy is going to be relative to kind of like the internet infrastructure build out of
Mhm.
the late 90s, early 2000s, and we're eclipsing that at this point. So this is a massive amount of money that's being injected into our economy, and we're seeing a lot of positive effects from that. And so we do see this as a huge tailwind, going to continue to drive a lot of economic growth, and it's probably going to continue driving economic growth for years, if not decades to come. So very, very excited about what we're seeing out of, all this AI spending. Of course, there's risks, but right now it seems like the upside is outshadowing the downside there. Um, and then again, just kind of like bringing it back to the conversation we had earlier around how people are feeling versus how things actually are behaving under the surface, what the actual data is telling us. And I know that you really like this chart here, Chris, but essentially what this is showing us is new business applications being filed here in the US. And you can see we're at almost all-time highs, basically highs we haven't seen since pre-GFC for new business applications. And if you think about, when if you're going to open a business, you're probably pretty optimistic about the outlook for the economy. And so that's
Yes.
kind of like what the headline there says. A lot of people say that they're worried about the economy, they feel very pessimistic, but this chart specifically shows that they're not behaving the way that they're feeling internally. And that's very optimistic for us.
Yeah, no, that's good. I appreciate you including that. And I did, right? Because the clientele that we serve are diverse. You have anywhere from a conservative individual all the way to a liberal, and then there's now more extremes within all of that. And my goal is to try and be someone who's somewhat agnostic in all those things and say, well, look, I want to look out for you regardless of where you are and your money. And so at times it's been difficult to let them know, well, here's something I can point to that is beyond all the media noise and all of the rhetoric and propaganda and whatnot that happens. And so things like this just seemingly cut through the noise. It doesn't have to be a guarantee, but it's like a glimmer of hope. Like you said, if things are negative and doom and gloom, why would you have such a record? And this is also in the recent, 12 months that we're seeing that spike. I haven't got an exact line on the grid there for the X and Y axis, but it really seems like the last 12 months, there's been a great deal of increase in desire to start something new. So that doesn't tend to
Yeah.
be, that could be out of necessity, but at the same time, that doesn't tell you as things are as dour as the headlines might lead you to believe. So that's great. I
Yeah.
appreciate including that one.
Yeah. So for us, again, I think the backdrop for the economy, while there's definitely risks, still looks tilted towards more positive.
Yeah.
And obviously that gives you a good backdrop for the stock market. And again, the stock market and the economy are not the exact same things. They're very different. But obviously they're intertwined. And there's lots of concerns that we're also hearing around the stock market. This chart here is a survey of global fund managers, so like professional investors, basically asking them, do you think equity markets are overvalued? And as you can see there, we're basically at all-time highs with a lot of these fund managers thinking equity markets are overvalued. I think we all hear this intuitively. I think it makes sense, right? Stock markets are up significantly over the last couple of years. largely driven by a lot of these tech companies, these Mag Sevens, like you were talking about earlier. And it just feels like at some point there has to be a reversion to the mean. There has to be some sort of pullback because things can't just forever and always go up and to the right. Things are feeling bubbly. I know a lot of people talk about, a tech bubble, similar to what we saw back in the 90s. There's lots of analogies there. But for us, when thinking about are things overvalued, you really have to take the price appreciation we've seen in stock market prices and break it down into what actually drives higher stock prices. There's a component of things getting more expensive, right? And that's on the right-hand side, that those purple lines, this PE, price to earnings multiple growth, that's higher valuations. But then also what drives stock prices that's more healthy is just like these companies making more money. That's earnings per share growth. And so you can see this line right here for the S&P 500. Basically, this is through early September. It was up right around 10% at the time that they found this data. Um, about two-thirds of that 10% could be attributed to stronger earnings. So just earnings broadly growing. That's obviously very positive. And there was some component of valuations getting a little bit more expensive. And a lot
I
of
see
people
that.
think that that's largely driven by tech. We know that tech has outperformed, especially over the last couple of years. And so surely you would think that that's just wildly expensive right now. But actually, what you'll see is, m more than 100% of the tech price appreciation we saw up until this point when this data was taking was driven by stronger earnings growth. And actually, from the beginning of the year, tech was actually a little bit cheaper. So it just kind of goes to show that what's driving
Wow.
stock prices right now isn't necessarily things just getting wildly expensive. They're being driven by very, very strong fundamental earnings growth. And for us, that's obviously very, very important. And it shows us that we're in a different scenario than we were back in, the late 90s when everything was being driven by multiple growth. You throw a
Mhm.
.com at the end of your business name, and all of a sudden your price goes up 100%, notwithstanding like, better earnings or anything like that. This is not the same as the 90s whatsoever in our view. These companies are wildly profitable. Margins are very, very strong. Um, and so we're pretty optimistic about the backdrop that we currently have in both the economy and in equity markets. And this last chart that we have here just kind of gives a little bit more historical context around bull markets. Right now we're about almost 3 years into this current bull market. And a lot of people think, hey, maybe we're long in the tooth with this bull market. At some point, surely we have to pull back. But there's been a whole lot of bull markets that have lasted longer than
Yeah.
2 years that have gone on to, 5, 10, 12 year bull markets. And again, if you want to compare us to the late 90s, early 2000s, that bull market lasted almost 13 years. And so
Wow.
we basically have a very long runway to go potentially for stock prices to continue moving in the right direction. Again, we think that we have a good economic backdrop and we have a good fundamental equity market backdrop to continue driving us forward. So, all in all, our feelings here at Horizon, we're still very, very optimistic, knowing that there definitely could be risks to the market. There could be like tiffs that go on between the US and China. There's always geopolitical risks, especially right now. So I'm not saying that any of this is guaranteed, but as we currently sit right now, withstanding some sort of black swan event, we're pretty hopeful about the next 12 months here.
That's good. Well, that's a little bit of a shift because I remember at the last quarterly review, we were believing that things could be good, but we wanted to be cautious for the next few months, so to speak. And it seems like some of those, maybe it was around tariffs and things like that, that were overhanging prior to. Seems like some of that may have cleared out based on the perspective that we have from what we're reading, if we're reading it all right, of course. So yeah, no, that's great. It would be great to know that we've got years more of this kind of growth. I think that could help people's bottom line in some ways and hopefully help out some families as well too. So hopefully this
Yeah.
growth is not just for the elites as it tends to be. So That's great.
Hmm.
All right.
Absolutely.
Well, anything else that you wanted to touch on today, Casey? I know we've gone over a lot of things.
No, I think we covered pretty much everything. Yeah, we can leave it there.
Okay. Yeah, and just for clients, we're going to be making a couple of changes to the constituency of some of our equity sleeves. It's because this is also shared with people who are non-clients. I'm not privy to be able to share that exactly what we're going to be changing, but based on some of the things that we've seen, we're making some amendments to the portfolios here. Likely by the time you get the chance to watch this, we will have already implemented those changes. But just want to give you a heads up that we have things we've been watching and to position ourselves based on what we think will be best for you and your best interest. Some of those changes will be put into effect, reconstructing a few positions within our portfolio. So, Casey, thanks for spending the time with us as you do, and the time you spend to prepare means a lot. Always appreciate it.
Yeah. Thanks, Chris.
All right.